Hey, what's up guys? Welcome back to the channel. So today I'm going to do more of an educational topic. We're going to do the topic of inducement. So let's jump to a blank spot in the chart. And what I first want to do is just a definition of what inducement is. And if you're a SMC trader or interested in SMC, inducement is a very important topic, so I hope that everyone takes away a lot from this video. Okay, so inducement. What is inducement? So inducement is something that persuades you to do something. So inducement, something that persuades you to do something. Okay, so we're gonna make an illustration to try and describe this in the market context. Okay, so imagine we have structure, right? Bullish market structure. Okay, so from a retail perspective, if you're a retail trader, what thoughts would you be having with market structure like this? Okay, so structure is obviously bullish. We have higher highs and higher lows. From a retail perspective, in all probability, there would be consideration given to support and resistance. So if in this situation we're trying to identify a level, we're seeing here's a swing low here and here's a previous swing high. So this was a level of resistance. We came up, tested as resistance, respected it, then broke through, and then tested as support. So potentially this would be a level that a retail trader would be considering for buying from, right? So this could be potentially this could be potentially what you would be looking for. Okay, so with retail they are considering something like this, trading a buys from this level with entries around here and stop losses below there, right? So when price is up here, retail traders are not participating in the market. They're not participating because they're not executing any trades. When price comes down here into the zone that they have identified, now they're willing to participate in the market. They're willing to bring their money into the market, right? So when price comes down into the zone, they are being induced, they are being persuaded to do something, which is they are being persuaded to participate in the market. So when price comes down here, various retail traders will be interested in entering the market, in executing buy positions. So there's going to be a lot of positions like this one, yeah, with entries at this level and stop losses below the low, because this level of support has been identified, right? So with that occurring below this level, there will be an accumulation of stop losses of all traders who are looking to buy off this level of support. So with inducement, we are looking at levels, right? We are looking at levels that are creating the impression of maybe support or maybe resistance. But in trading, everyone who is trading price action, in a sense, we are looking at levels. Wherever you are buying or selling from, you're trying to identify a level that you believe is going to be respected and that's why you base your trade there, and that's why you place your stop loss. So this level we can identify as the inducement, right? So now when price comes down and various traders are persuaded to trade from this level and place stop losses below it, what is smart money looking to do? Well, they are looking to first trap everyone. So when price comes back into this level, there might be lower time frame indications of it being respected, so that more and more traders are induced into entering the market. Once a sufficient amount of liquidity builds up below that level, what would smart money do? Drive price lower below the level and then reverse it in the correct direction, right? So inducement, remember, inducement is something that persuades you to do something. So in the market context, inducement is when retail traders are persuaded to enter the market, to bring their liquidity into the market, right? Okay, so let's quickly talk about the two types of inducement. So the first type, so if we have market structure bullish, and then we have a situation like this. Okay, so with bullish market structure here we have a supportive level that is being engineered, and here we have a level of resistance which is being engineered. So if we imagine this is the price action that is occurring within a day, like maybe in a London session or something, but this is the overall structure, so structure being bullish. If this consolidation or range develops over a session or over a day, it's creating a level of resistance and it's creating a level of support where there's equal lows and equal highs. So now this is the first type of inducement, because when levels of resistance and levels of support are being engineered and they can be identified by there's formations happening in the chart such as double tops and double bottoms, this is the form of inducement, because now many retail traders who was looking at this are saying, okay, structure is bullish, but we seem to be over and extended to the upside, and now we're creating a double top. So there's various retail traders who would be interested in selling from this resistance with stop losses above here. At the same time, with traders who are looking at structure as being bullish and looking for a continuation, they're seeing, oh yeah, is a support being created here. It looks to be a strong support, so they are looking for buys from this level with stop losses below. So what does smart money intend to do? Well, this could potentially be what occurs, that they drive price up above the resistance to take out everyone who is in sell positions, and then they drive price down below the support to take out everybody who is in buy positions based off the supportive level, and then they reverse price in the correct direction, right? So that is the first type of inducement, it's support and resistance. The next type of inducement we can also see here, and it's called, and I have spoken about it before in my previous videos, it is trendline liquidity. So with trendline liquidity, you'll see here's a low and here's a higher low. It's not to say there's going to be an actual trend line, so there doesn't have to be a situation where you can take a trend line from the first low and then there's a touch on the second and then a third touch. It doesn't have to have a respect in that sense, but what there needs to be is that there's a bullish sequence and the sequence isn't broken. So if there's a low, a higher low, a higher low, there's a sequence of higher lows and that sequence hasn't been broken. So there isn't a candle that's coming and sweeping one of those lows. So in a situation like that, you could be looking at the trend line liquidity to be the inducement. So in this situation, let's say for example, we're now looking to trade and we want to do a bit of a outlook or an analysis, right? So if you're a smart money trader, you're looking at structure being bullish, but structure being relatively high, being at a premium. So you want to trade from a discounted level. And yeah, in my previous videos, we have discussed premium and discount, but let's also just look at it quickly. So if we imagine this being the low, so we take a fib, place it on the high. Let me just get a different fib. Place it on the high, right? And then here where the 50% level is, this is equilibrium. So above the 50%, this level is a premium level. Below 50%, this is a discounted level. If you are bullish, you ideally want to buy below the 50%, in some kind of a region below the 50%, because then you're buying low, you're buying at a discounted price. Whereas when price is at a premium, it's high, and you shouldn't really be buying at a high price. So if we look at price in this context, and let's take this line away, so we can see there's inducement here. So here's bullish inducement because here's a support that was created, plenty of liquidity being generated below it. But the problem with it is it's at a premium. So we look at where's the discounted zone and we look for the inducement below discount or within discount. So if we're looking here below the 50%, the first inducement is this low of the trend line. So the highest low within the trend line liquidity. So we can also just draw a horizontal line to represent that inducement. And then ultimately, what are we looking for? Is price to trade below this first inducement, below the inducement in the discounted zone, and then for price to reverse like that, right? In this situation as well, we have also trend line liquidity. We have the low here and then another low here, but here we have already actually drawn in, or yeah, with this horizontal line, you'll see the trend line being the low and then the higher low here. So this horizontal line that's showing the inducement is actually the trend line liquidity in this example, right? Okay, so let's remember, inducement is what? It's something that persuades you to do something. In the market context, it's levels of support and resistance, or some kind of a engineered trend line that induces, so it gets retail traders to participate in trades, in executing trades, so that liquidity is continuously generated in the market, right? Okay, so now that we've actually looked at that, let's look at the charts and let's just find some examples so we can just understand it better. So I'm gonna remove those drawings. Okay, so looking at price from this perspective, this is Nasdaq on the 4 hour. This was around the end of Feb, so over a month ago. Okay, so what are the specific things that we can see here? Okay, so major thing that we can see is that there's a prominent low here, right? and now price breaks below it. So here is a bearish breaker structure, and we can look at it as a fairly significant major break of structure, being on the 4-hour. So break structure to the downside and then continues lower. There's a low, lower low, lower low, till eventually this low is created. When this low is created, we can say, okay, here is a swing low that is formed in price, right, with this being a high. So if we look at this as an impulsive move, now we can potentially look for, if we are looking for continuation to the downside, we can potentially look for a retracement for price to move into a premium zone before continuing lower. So we take a fib from the high, the swing high to the swing low, and we look for equilibrium. So equilibrium being this line here. I'm actually going to use a normal fib. So this is equilibrium, but equilibrium is not the only point, right? Because it's the zone above equilibrium that we're interested in. So it can be, just a few pips above 50%, or it can be, the deeper levels such as these levels. But we want to identify everything above here as potentially zones we want to look at to trade from, right? So before we actually look at that, we first need to, or while we're looking at that, we need to find the inducement, right? So because what we ultimately want to do is identify the inducement, and then identify the inducement that is at a premium, and then look for premium inducements where there are points of interest that we can trade from that's above the inducement. Okay, so looking here, there's a few things that we can see. Firstly, we have this high and lower high, lower high, lower high. So we have a nice trend line that is forming here. And this is we're looking at from the perspective that price is still down here, and we're potentially looking for it to trade up, for it to continue down. So there's inducement here, right? And then right above this, you see here's a fair value gap. And from this zone, from this consolidation in price did break structure. We broke these lows here. And then here is nice fair value gap and a point of interest here. So this would be one area, and remember the 50% was around the zone. So this is definitely a valid zone to look at. At the same time, if we look at the high of the zone, what do we see? Well, we see a high, and then to the left we see basically equal highs, relative equal highs to the high of this price region, right? So now this is also inducement because it's giving relative equal highs. It's giving a resistance. And why is this relevant? Why is this inducement relevant? Well, there's lots of things. The first thing is that the 50%, so the equilibrium point was over here. So this inducement is at a nice deep premium, meaning that the levels above this inducement will be the 61 to the 78% retracement, which is ideal for, you don't just want to trade from the 50%. The 50% is just the barrier that you're looking for price to cross, but you ultimately want to see price go into a deep zone. So here we have two zones that we've identified when price came down here. We've identified trendline liquidity, that's the inducement to this point of interest, right? This is a valid point of interest, but we remember that this is at equilibrium, and there are other there's inducement above this, and there's points of interest at deeper premium zones, right? Because above it, here we have relative equal highs, and right above that, here we have fair value gap. We also have a opening gap over here, and then we have a 4-hour order block here, and this is obviously at the deep premium. If we get the fib out again, just to look at where our inducements are located. So fib is taken from this high to this low. You'll see 50% here, so this is just above the first inducement, basically in the middle of this point of interest. But here we have the 61 to the 78% over here, and then the midpoint of that is here around the 70%. So this inducement, where we have these equal highs, you can see it's just above the 61%. So this is a prime zone. Okay, and then we see here we come into it and we trade lower, right? So that is how you use inducement in a sense. From a bearish perspective, you're obviously looking to trade from a premium, so you locate the inducements that are occurring around the premium zones, and you look for the points of interest that are above those zones. And then ultimately what you want to see is your inducement being swept, and then for lower time frame to give an indication of a respect of the point of interest. So if we look here, when we come into it, here's a good sign, because you see as we come towards this inducement, market creates a swing high. So we have a turning point here. So it's further inducing. It's giving more indication of a respect of this high, of this level of resistance. So to trade it, there's multiple ways to trade it, and we don't like this. We're not really talking about entries and stuff, but we can look quickly at looking at how to trade it from a confirmation point of view. So here we want to look at how price approaches it, right? So here, as we approach it, we create a high, we retrace, and then we continue up and we sweep the inducement and we come into the point of interest. So here we have a high, which is also a minor inducement. It's an inducement in the approach to this inducement, right? Because now as we show respect to it, it gets more traders interested in potentially trading shorts from here and generating more liquidity above the high. So we have a break of structure to the upside when we go above that high. The low is here. So if we get a break of this low, then there is a change of character, bearish change of character. So here's a bullish break of structure, bearish change of character. And then this being the point of interest that you could have traded from, because when there is a change of character, we can basically repeat the same process where we're looking for the premium zones to trade from. We look for a point of interest within there. So here this is lining up with the 61%, which is a nice premium to trade from. And then obviously you target liquidity, right? So you target inducement. So you use inducement to enter and to target, to exit. So the inducements to target would have been initial, or small target would have been these lows, because this is also inducing, because there's a supportive level that's created here. Here market breaks to the upside, so it makes a higher high above these internal highs. There would be traders who definitely, when price comes back in, they're looking to buy. So lots of stop losses being generated below these lows. And why do we target inducement or liquidity? Because those are the points in the market where price can potentially reverse. So the next zone would obviously be the major liquidity, the low. to target. And as we can see, once we sweep into here, price actually reverses. So now, just how we looked from a bearish perspective, and we understood the narrative of price using these inducements. How, if you think about this, when price was here, right, and then we broke lower, and we had all these lower highs that were formed. Every time these minor lower highs are formed, even this one, this one, this one, every time price traded into it and showed a respect, it's showing a respect of a level, right? So like this high, if we look here, we look to the left, we have here this previous support that now we break below, and we turns into a resistance, and now it's showing respect. This is generating a lot of liquidity above these highs, because now as it's showing respect, traders are trading from here, trading shorts from here, and then as we retrace in, they're trading shorts from here. So wherever there's an accumulation of positions occurring, there's stop losses being generated above the highs. So this is the first inducement, the trend line, where there's lots of stop losses that are generated here, either from traders who trade down as it's coming down, or potentially traders when price trades back into it, looking for continuation shorts. Here as well, here was relative equal highs, so here was a resistance form. So this when there was this consolidation in price, it generated a lot of stop losses above here. So market seeks to take that out before going in the opposite direction. So just how this whole process and the narrative of price unfolded in the liquidity and even in the change of character, just how it unfolded from a bearish perspective, we need to look at this potential, because your price reversed. So can we have a similar process of looking at price from a bullish perspective? So to do that, we need to look at more of the price action, because we need to look at where price is coming into. So looking at this end of price, right? Let's make it a bit smaller. And now we're just gonna look at the bullish inducements. So the bullish inducements, they would be, so these would have been bearish inducements, because these are the ones that when we're down here are above price, and we're potentially looking for price to reverse in a bearish way from it. These being bullish inducements, we're looking at if price comes below it, is there potential for reversal. So if we're looking at this impulsive move coming up, here's multiple inducements. And what are we saying are the inducements? Well, like I said, there's the trend line liquidity, right? So here's a low, here's a low, here's a low, and here's a higher low. So here's 4 higher lows. So this is a trend line, right? Trend line liquidity. However, if we draw a trend line, there's not going to be real respect on it. So that's what I mean when I say there doesn't need to be a respect of a trend line. There needs to be a sequence of structure. So in this case, a bullish sequence where there's higher lows being formed and there's no sweep. The sequence isn't broken. So we're looking at least 1 or 2 or more. With a trend line liquidity, it can be one of the lows or a few of the lows or all of the lows to be swept before the price reverses, if there is higher time frame confluence for that move. Okay, so the first inducement would be this low here, because it's quite a strong low. You see it comes and it sweeps the lows, like so. If we're looking here, before this goes up, you see we have relative equal lows, so we have a supportive inducement that is created here. Before price moves up, we sweep all of these equal lows where the support is created, and then we continue up. So this in itself now is a good inducement. It's a strong low. Then this low as well, and this low. So we're gonna look at each of these and see when price comes into it, right? So let's just draw our little line segment here, and you'll see so here we have the first inducement. Price comes into it, sweeps it here. You'll see it sweeps it just by a few pips here, and then price moves up. So in this situation, price does not reverse. It doesn't go up and create new highs, but we have this move, and this being on the 4-hour time frame. 4-hour inducement is relatively strong, so even if it's not going to be a move that reverses price, for intraday trading it's solid. You can catch good trades. Like if we look at this, for example, this is around price 12,000, and then we have a move up over 200 pips, like about 220 pips. So the catalyst of this retracement was this inducement. We just came into it a few pips, and then we had a intraday reversal of over 200 pips upright retracement. This inducement below it, here is a point of interest. This is definitely a valid point of interest between this low and the next inducement. And we can see so the next inducement is this one. Next major inducement is this one. So between these two inducements, okay, and let me actually put that. Between this inducement and this inducement is a point of interest, right? This is a point of interest. So when we sweep it for the first time, we have a positive reaction. When we come into it again here, we have a positive reaction. When we move deeper into this point of interest, we come into the midpoint of the point of interest. And now remember, with this being a point of interest, and this was the inducement, but it was already swept. But now you see, here we have a low, and we have another low with the first one which swept it, and then we have another low here. So this is creating what? More inducement. It's a larger support that before we come down here, because now it's a low and then a low and then a low. So it's like a triple bottom in a sense. So now this is also still the inducement, and it's still inducing into this point of interest, because this point of interest, there's still a lot that hasn't been filled in it. So here we come into it again, we sweep these relative equal lows, and then we have another strong move. This is like about 250 pips up, and then but then you see the bearish structure is still being respected, right? So from this, when we're seeing a respect here, and we're saying, okay, potentially there can be more continuations to the downside, because why? There's more inducement here, and there's more fair value, there's more inefficiency, there's a point of interest even more below price that we can come deeper and deeper into. So here for the next one, we come in again and we sweep it just how we swept this one, like barely by a few pips. This one as well, like we sweep this level, and remember, this is all part of a trend line liquidity. So low, higher low, higher low, and then we just use these horizontal line segments to indicate where each of the lows are, and then we sweep it here. Then from this perspective, if you were buying from this perspective, what are you targeting? You're targeting the inducement, because why? Once we come into the zones above the inducement, price could reverse, like how when we came in here we had a reversal, and then the opposite, or the bearish process, but the same thing, looking at the inducement being taken out and going into a point of interest for potentially reversing. So it's the same on this side. The inducement's taken out, we come into a point of interest, and then the price reverses. Okay, so, and with this now looking when price comes down here, what do we have? We have a low. We have a low that has been swept now, but when it's only swept like by a couple of pips, and then it's still looking like relative equal lows. So this is still inducing more, because below price, here we have 4-hour fair value gap and a 4-hour order block, which hasn't been tested, because when we came into it, we only came a few pips in below this inducement and just into this point of interest, but there's still more to be filled in this point of interest, right? So here low, then another low. So it's relative equal lows creating a support. And this is a valid change of character, because here we have bearish structure, low, lower low, and then we break these highs. So we break higher. This would have been a reasonably valid area to look at for buys. The problem is, where's the inducement? There's only a small bearish candle here. You see this bearish candle that's here? So you could have looked at this being the inducement, because if there's a bearish candle here, there's a small high and then a higher low here, and then market continues. On a lower time frame, there's like a retracement here. So we could have looked at this to be the inducement into this fair value gap. But this is very minor, and when there is not a strong inducement, like where there is not a low, a proper swing point like that we can look at as inducement, then we can look at the low as being the inducement, because now there is no low that's in here that's inducing, so the low of the impulse is actually the liquidity. And then we have further confluence being this unfold region. There's 4-hour fair value and a 4-hour order block, and this broke significant structure here and continued up. So there's lots of confluence for price to come deeper into it. And then just how when we tapped into this zone above price and we looked for that lower time frame shift, we can do the same once we mitigate into higher time frame points of interest, right? When we sweep the liquidity, when we take out the inducement. So here we have a low that's formed, and then we sweep it. So market makes a lower low. That's a break of structure to the downside. The highs are here, right? So this is the change of character. But at the same time, just looking at all of this, right? Here's inducement, this low. We sweep it. We come into a higher time frame zone below price. If you're a buyer from here, lower time frame buyer, you're looking above price, there's relative equal highs. You could potentially target that. Because why? Above it, here's a point of interest that's located at a premium. If you're taking a fib from this high to this low, you're seeing this is at a premium. So you could see potentially for price to come into the zone and then to have some kind of a bearish reaction, because we're coming above the inducement into a premium where there is a valid point of interest. Why is this a valid point of interest? Well, it sweeps liquidity, it mitigates into higher time frame order flow, and it breaks structure, and it engineers liquidity prior to the point of interest. So here, as we come into it, you see we come around the midpoint of it and we respect it to the downside. But from this perspective, if we're seeing this as a break of structure to the downside and then a test into a higher time frame bullish zone, then we come above these highs, so we change character to the upside. We're potentially looking at continuation buys. So from here, what we're looking at, structure bullish, we have a change of character here. We're looking at the premium, where's the premium and where's the discount. So if we're looking at the impulsive move starting from here, because it's coming from here and it's breaking the highs, so we're taking the fib from the highs to the lows, being the high and this the low. So this is the impulse. We're looking for the 50% being this line here. And where's the inducement? We're looking for the inducement that's at a discount, because we're looking to buy. So the inducement is this low here. It's a very clean 4-hour low, because right below it, firstly it's at a discounted zone, and then right below it is a clear 4-hour fair value gap with an order block there. So potentially look for buys below this inducement in this order block. And then where do you target? You target liquidity. So here's the low, here's a high, here's a lower high. So here's trend line liquidity. Could potentially target these to be taken out, or alternatively have larger targets. So here as well, trend line liquidity. Here's a high, here's a low, here's a lower high. So you look for at least one of the highs to be taken out, because that is a good region for where price would potentially reverse or show some resistance. So like here you see when we come into it, price shows resistance, and then like you can see it here as we come up here. Here's a low, higher low, higher low. So what do we have here? We have a trend line forming. We have bullish structure with a trend line forming. Prices at a high, prices at a premium. You're looking for price to retrace into a discount. So you're looking at the fib, you're looking at this, the 50%, all of these lows. So these lows is the inducement. So we can see which inducement is ultimately taken out. This one, we sweep there, and then we reverse. And what do we have above price? We have a high, lower high, lower high, trend line liquidity. So look for price to take that out as well. When we're up here, we can see the same. We have a low, a higher low, a higher low. So we could potentially look for price to come from a premium trade below the liquidity, below the inducement, into a discounted zone where there's clear inefficiency for eventually price to go higher. Okay guys, so I hope you guys enjoyed that and found that educational and insightful. Remember, inducement is something that persuades you to do something. So in the market context, it's levels of support and resistance and trendline liquidity that is inducing retail traders to participate in the market, but so that eventually their positions can be taken out, right? So like in this perspective where there's a trend line being formed here, there's a lot of stop losses that are being generated below the lows of the touches of the trend line. Eventually market takes it out, and what you're looking for is firstly identify structure, then identify what is premium and what is discount. So here we're identifying, okay, there's bullish structure. We're identifying that the discount would probably be below this region. Then we're looking for the inducement that is in the discounted zone that has a point of interest below it, and then that's how we're trading. And then we're looking for the inducement. If we're trading buys, we're also looking for the inducements above price, because those could be potential targets, but particularly if there is higher time frame confluence for a bearish reaction to occur. So potentially above these highs, maybe there's a higher time frame point of interest here or somewhere, a previous week high or something, or weekly fair value gap or whatever, to potentially run price into, because now we're taking out bearish inducement into a bearish point of interest. And then we also looked a little bit at the confirmations. Like here we looked at how once we take out the inducement and we come into the point of interest, how we can look at the lower time frame to shift. And then we also repeat a similar process where we're looking at structure, we're looking at premium and discount, we're identifying the inducement in the discounted zones if you're bullish, and you're also identifying if there is a point of interest that is beyond the inducement. So in this case where it's bullish, you're looking for points of interest below the inducements that are in discounted zones. In this case, when you're looking at things from a bearish perspective, you're looking for the inducement that is in premium zones, and then also the points of interest that are above it. So guys, I hope you enjoyed that. I hope you found it educational. Please don't hesitate to reach out to me on Instagram or comment on the video if you have any suggestions or anything. Also check out my Instagram. I have courses and mentorship that I offer. It's Nazim FX, NAZEEM FX, if you don't follow me. And yeah, look out for my weekly review to be posted as well in the course of probably today sometime. I'm going to be looking at some things that happened on Nasdaq over the week, and also looking at the week to come, because remember, on Wednesday there is CPI, and then also on Wednesday, later on Wednesday, there is the FOMC meeting minutes. So this upcoming week should be a very big week, and also the fact that it's Easter, it could cause some disruption and also some uncertainty, because NFP on Friday wasn't really a normal NFP. So is there going to be increased volatility to compensate for that, or we'll see what happens. It should be interesting. Other than that, enjoy the rest of your long weekend, guys. Enjoy the rest of your Easter and be safe. Cheers.